right now to talk about their numbers. Mr. Rao, at the start of this commodity bull cycle, we thought it's going to turn out to be a multi-year bull cycle. Now, 18 months into it, and it looks like the tide has already turned. Let's talk about the steel industry in specific. From the $75,000 per ton, we're now down to below 60,000 per ton. How much more could it fall to before it stabilizes? And what is the worst case scenario that you're penciling in?
No, globally in the last quarter, after the Russian-Ukrainian war, the prices of energy commodities have gone up, particularly coking coal or thermal coal. So they have gone up to as high as $600. The costs went up. This is one reason. But at the same time, in the rest of the world, particularly the China, the supply of steel has gone up. So quarter on quarter, if I look at Chinese numbers, the production went up by 16%. So when the domestic demand was not able to absorb, they have increased their exports by 53%. So their exports in the Q2 of the current calendar year went up by 53%, which is close to 20 million tons. So more supply of steel in the international markets, more production. At the same time, Russian-Ukrainian war has caused anxiety across the world. Several countries and also central banks have taken contractionary fiscal and monetary policies that also had a dampening effect in the market. All these three together, we have seen a fall in the steel prices. But after having fallen by almost close to 20% in Asia and around 30% in the US and the European markets, what we are seeing now is stability. And because now there is a stable outlook for the steel prices in the global markets, we are also seeing buyers coming back to the market, and a lot of inquiries are coming in. This is the scenario not only overseas, but also in India. Similar situation we have faced in the last quarter. Now we are seeing a stability in the steel prices and also inquiries increasing, which is a good sign.
Hi, Mr. Rao. Good morning. This is Anisha also joining the conversation. You talked about how the overall outlook of the sector is looking like, but this quarter margins were impacted and they've come in lower than consensus estimates due to the spike that we saw in the coking coal prices and other input costs as well. But with respect to how the steel prices have moved in tandem with coking coal prices, where do you see that trend moving from here on?
Last quarter, it has gone reverse direction. When steel prices started falling, coking coal prices, because of the Russian-Ukrainian war, went up. So that has caused a huge amount of pressure on the steel companies' margins. That is one of the reasons. But in the latter part of the quarter, we have seen some correction, particularly in July in the coking coal prices. But in the last quarter, the margins were affected, high input prices, and the second is falling steel prices and a little bit weaker demand, both globally and also in India. All three factors together put pressure on the margins. But what is very important to understand JSW Steel numbers is the one-off items. There are 4 items are there. If somebody makes adjustment of these 4 items, then the EBITDA per ton, in fact, will go up by 4,300 rupees. It is not 9,600. It is close to 14,000 rupees per ton. So these 4 items, if you give me a few minutes, I'll just explain quickly. One is when the coking coal prices started falling. Similarly, steel prices started falling. At the end of the quarter, we have to make an adjustment of net realizable value on the inventory. That amount is over 800 crores of rupees. Second item is foreign exchange fluctuation. The rupee depreciated by over 4%. So whatever foreign currency loans we have, those loans have to be translated. That translation loss will go and hit the P&L. That is over 700 crores of rupees. The third item is the Government of India imposed export duty on export of steel. So whatever exports we have made, we have paid duty on that. It is close to 250 crores of rupees. The last item is some 78 crores of rupees. There is a write-off of the grant given by the US government to our subsidiaries in US during the COVID time. They rejected that grant. So we had to make a provision of that 80 crores of rupees. All these 4 together, there is one-off items of 1,880 crores of rupees to profit and loss account in the last quarter. So if you make this per ton, it works out to 4,300 rupees per ton. So 9,600 rupees reported EBITDA, if you add this 4,300 rupees, this is close to 13,900 rupees EBITDA per ton. If you look at even in this challenging environment, the EBITDA, adjusted EBITDA per ton is very, very healthy.
How will the coming quarter shape up, especially in terms of margins or EBITDA per ton?
Q2 remains challenging. Why I'm saying is the steel prices started falling in the latter part of May and thereafter. So full impact of fall in steel prices have not come in the Q1. So the full impact of fall in steel prices will come in the Q2. That is one. Number two is the high cost coal, which we have bought when went up to $600 plus in the Q1. So that is in the inventory. So that cost is to be absorbed in the current quarter. So part of that cost, high cost, will come in this quarter. So the real benefit of lower cost on account of coal and iron ore and other costs will get reflected in the consumption only starting from later part of September. So costs will remain at an elevated level, and the fall in steel prices will come fully in this quarter. These two together, this quarter margin will remain more or less similar.
Okay, so in the context of where we are, Mr. Rao, are you sticking with your FY23 guidance in terms of production as well as sales guidance, and what happens to CAPEX?
Yeah, if you really look at our overall production was 5.88 million tons on a consolidated basis. We have given guidance of 25 million ton production. So we are more or less very close to our guidance. This is despite preponing part of the shutdowns to first quarter. So we are very confident that we'll be able to reach our production guidance in this quarter, in this year. Then as far as sales are concerned, sales were slightly lower. The exports were affected. Exports have fallen by 35% quarter on quarter. And the domestic demand, apparent demand was weak, even though real demand was not affected. So these two together had an impact in the last quarter. That's why our sales volumes were 4.33 million tons. So we expect we will be able to make it up in the following quarter. So we are not changing our guidance as regards to overall sales and production volumes for a financial year.
So can you talk about the representations that are made to the ministry for rollback of export duty? Have you been a part of deliberations? What is the sense that you get?
We do not know when a decision will be taken by the government, but based on the past precedents and whatever duties that were imposed in 2008, they were for a very short term. So we represented to the government the impact on the industry, which they're also seeing through various results of various big companies in the steel sector. So we hope the government will take a favorable view on the duty. I think as I explained to you, India is losing out in terms of exports. Our exports from India, steel exports from India have fallen by 26% quarter on quarter, whereas Chinese exports have gone up by 53%. So what India is losing, somebody else is gaining. So therefore, we are moderating production, we are reducing capex, we are not able to export, and some other country is gaining. So it is not a very good situation. So we expect the government of India will take a call on the export duties. What is also very relevant here is in the month of June, if I look at steel mint published prices, June 21 versus June 22, petcoke oil prices have fallen by 7.6%. Year on year. Therefore, there is a clear deflation as far as the steel prices are concerned if you compare year on year.
Okay, Mr. Rao, we let you go on that note. Yes, a lot hinges on what will happen to that export duty levy. Will there be a rollback or not? But only time will tell that. We'll let you go on that note. Thank you so much for joining us today. But from